Hello, my name is Nick Griffin. I'm the Head of International Strategy at K2 Asset Management, and this is the third quarter 2015 webinar for the K2 International Select Fund. What we're doing here is just providing you with an update as to how the fund performed over the quarter, what happened to markets over the quarter, and how we're positioning the fund going forward. And ultimately, this is just a short 25-minute presentation that gives you a bit of transparency as to what we're thinking about the world and what we plan to do going forward. We hope it provides insightful and some insight into what we're doing in the fund, and please come back with any questions if you have any along the way. It'll take about 25 minutes. I've got about 20 slides to go through here, and thank you for listening. So firstly, just the agenda. We've got 20 slides to go through here. They've got a few where we're going to talk about the outlook for growth and how that's changed over the quarter. Secondly, we're going to talk about the outlook for markets and where we think markets are going to go going forward. Thirdly, we'll just give you an update on the changes we've made in the portfolio. And lastly, we're just going to give you an update on e-commerce and some of the bigger investments we've got there. So firstly, on the outlook for growth, this first slide I'm showing you is just US growth forecasts over the last 5 years. And unfortunately, similar to previous years, we are following a similar pattern whereby growth forecasts are high at the start of the year, roughly 3%, and as the year goes on, they get downgraded closer towards 2% in the US. This time we held on a bit longer in 2015, but ultimately the weakness in emerging markets and the strong US dollar has pushed down growth forecasts, and this has been disappointing for markets, particularly in the September quarter. In terms of the labour market, though, the US is definitely not collapsing. The labour market has been strong. We have seen some recent weakness, but ultimately the recovery is still underway, albeit subdued in the US. And this I think, is the problem for the Fed, where they probably should be hiking rates, but it is creating volatility. So they're intentionally waiting longer and longer. But from that point of view, they really should focus on their own economy. And so at some point, provided these numbers hold up, they should eventually get around to hiking rates. Just talking about that interest rate outlook as we speak, what you can see here is the actual Fed interest rates over time and what the FOMC would like to do according to their forecast, to their medium projections, and what the market wants them to do. And what we're seeing here is a gap. This gap's been open for a while. We've showed this slide before. And that's always meant that this period was going to be quite volatile as the US tried to exit quantitative easing. The market has a different view to the Fed, and we need these two lines to come together, and ultimately they probably are at the moment. The Fed decided to wait in September and not hike rates, and potentially they'll wait again in December, and so ultimately the market and the Fed will come into line as to what is the right outlook for interest rates, and that will definitely reduce the volatility at some point. And obviously we still have a few more meetings to get through, but this is a gap that us and many others have flagged and something to be wary of going forward. In terms of growth, I think this is the main reason why markets have corrected and obviously has caught us a little bit by surprise as well. We show you this slide every quarter, and what you can see here is the purchasing manager indexes for around the world. And we update them essentially every month. And so ultimately the purchasing manager indices, if it's above 50, that's good. And if it's below 50, that's bad. And if it's getting worse, then it's deteriorating. And what we've seen here basically in the third quarter, is this big downtick in Chinese PMIs, also a downtick in obviously Brazilian PMIs, and that also affected US PMIs over here. And so what you can see there is effectively the effect of emerging markets on the US, i.e. it hasn't been immune. And secondly, obviously the effect of the strong dollar on the US hasn't been immune. Elsewhere in Europe, where the currency, and Japan, where the currency has been weaker, they've been much less affected. But ultimately, it was this downtick, particularly in China, that's caught the market off guard and caught us by surprise. And so growth is essentially weaker, which means earnings have been weaker, or the forecast for earnings is weaker, and hence the market has corrected. And that shouldn't be a surprise in hindsight. What surprised us, I suppose, is this downtick. What that's meant is we've had a lot more volatility, and the volatility has continued through the September quarter. That volatility is obviously focused around commodities and equities in this quarter. Currencies have also been quite volatile, while bond yields have been less volatile. And this volatility in equities is not to be unexpected, but and it was always, I suppose, going to happen through this difficult period. But it's obviously something that's going to be with us for a little while yet. And from that point of view, you should just be aware that we do need the growth picture to stabilise somewhat and the interest rate outlook picture to stabilise before that volatility will calm down. All of the volatility, in particular commodities, is putting short-term effects on inflation. And as you can see here, our short-term inflation forecasts are deteriorating. Long-term still say well pegged. Ultimately, that's what's keeping the Fed on hold. And it is worth flagging that obviously commodity weakness is unlikely to roll over into next year. And so as we do roll over these lower commodity numbers, the short-term inflation should improve. Inflation should get back towards targets and give, I suppose, the environment for the Fed to hike rates. But at least at this point in time, we do have more deflationary impulses in the market, which is not great. So that's the outlook for growth, and I think in summary, it's probably got obviously worse since we last updated the market, and probably a little bit worse than what we thought, particularly in China. But from that point of view, it is worth flagging that it's not necessarily the end of the world for markets. And so let's just go through now the outlook for markets. So what's happened in the last quarter here, and what we're showing you here is the US S&P 500 index forward valuation. So the big bar lines are the EPS of the entire market, and as you can see, the EPS of the market has come off. This has already started a quarter ago and it has continued as people have adjusted their estimates for the strong US dollar, but also adjusted their estimates for weaker emerging market demand. What we've also seen is the PE of the market has come off somewhat as they forecast lower demand for next year, and obviously forecast that these earnings estimates have probably still got a little bit further to fall than what analysts have already got in their numbers at the moment. The good news is that the bond market has obviously remained fairly subdued through this period, and if anything, interest rates have fallen again. So that's meant that the earnings yield versus the 10-year bond yield has opened up this quite large gap again, and it's this gap that's essentially been supporting equity markets since 2008, 2009. And what this gap does is it essentially is the yield carry for holding equities. So even if you don't want to take risk and invest in equities, then equity managers or company CEOs can. And so what they can do is they can borrow money cheaply in the bond market and use it to either buy back stock, to increase their dividend, or to invest in capital to do M&A that is accretive to earnings, or to invest in capital equipment projects that will also improve their earnings going forward. And that's driving the earnings growth of the market, and it's been driving the growth of the market since the bottom of the recession in 2008. And so these conditions are still in place post this recent growth scare. So while the growth scare is obviously bad for earnings, ultimately the yield underpin, or the low yield environment, is still prevailing, and so ultimately equities are supported by this equation that has been in place for quite some time. It is worth flagging, though, that the bond markets are not open for everybody. What I'm showing you here is US high-yield bond spreads versus the 10-year government bond spread. And as you can see here, the high-yield market has essentially blown out considerably as investors in the high-yield market have become significantly more discerning as to who they're lending money. And that's partly due to the problems in the crude oil market, or the commodity market, particularly in the US, partly due to some of Glencore's problems that you probably read about during the quarter, and partly due to some of the problems in emerging markets. So credit markets are still open for investment grade borrowers and still very cheap. For the less investment grade borrowers, it's getting harder to borrow money. That is good in the fact that we're not getting bubble-like environments here, and so it's a natural correction, but it is a drag on growth, because if you can't borrow money as easily, then you can't invest money as easily. So it's another reason why obviously the growth outlook has deteriorated somewhat since we last spoke to you. Just in terms of valuations, well, obviously they've corrected significantly, and you can see here now that most markets in the world, be it the US, Europe or the UK, are now trading below 15 times next year's earnings. Yes, you could argue that next year's earnings still look a little bit high, but the dividend yields are also quite positive, with many markets now above 4%. And as I flagged, versus interest rates, that is very supportive for equity markets. So unless you think earnings are about to collapse, this is back to a reasonably supportive level of valuations post the correction, and the reason why we don't think, even though growth has corrected somewhat, that equity markets are going to correct significantly, because they do have this valuation and support from effectively low interest rates, and we've seen that for some time, and obviously it has been pushed out again, so low interest rates will stay for a bit longer than everybody thought they would. So that's the outlook for markets and the outlook for growth, and so now I'm just going to update you as to how the portfolio is set up in that environment and what we've done to basically counter it going forward. So as you know, with all the K2 funds, including the K2 Select International Fund, there's 3 tools that we have available to create alpha and create returns. The first is obviously stock alpha, and that's where we just try to find the best stocks in the market or the ones that we think are going to grow somewhat regardless of the cycle. The second is variable beta. This is where we're basically deciding, do we want to be fully invested or partly invested in market? How much cash are we holding? And the third is currency, and that is how hedged or unhedged do we want to be the Australian dollar, i.e. do we want to benefit from the Australian dollar falling, or do we want to protect clients from the Australian dollar rising? And I'll just take you through where we are on all 3 at the moment. So this is just the variable beta component, so how exposed are we to equity markets, and as you can see, this shows the fund since inception in 2005. And we can be as high as 100% invested as we were through 13 and 14, and as we came into this correction we were roughly 70 to 80% invested. So we had raised cash expecting volatility. I don't think we were the only ones in the market to see that coming. I think most people were wary of this period. Yes, it would have been nice to have more cash, but obviously prudent to have some cash. We have reinvested some of that cash, so we're back up to about 80% invested during some of the very bad days, and I'd expect us to get more constructive in markets as we work through this 4th quarter. And so from that point of view, as I tried to flag, we're not ultimately that bearish markets here because of the yield support that they create, and they are the asset class of choice. And so we have raised some cash, and then we've used it, we think, quite wisely in the last couple of weeks, couple of months to build back up to 80%, and hopefully we can continue to use it wisely and build back closer to a fully invested position through the 4th quarter. In terms of the currency, with the currency, essentially we have the choice to be 100% hedged or completely unhedged, and as you can see, we've been running a hedge position for many years, and then for the last couple of years we've been running an unhedged position. And what you see here is us trying to benefit from the falling Australian dollar, and we've done our best to basically collect as much of the upside there as possible. What we did during the during the 3rd quarter, was to increase our hedging back up to 50%. We basically felt that in the low 70 cents that the currency, most of the best gains from the currency had been collected. And so from that point of view, we wanted to protect the downside if the currency actually rose. What we probably missed is the extra or the second wave of weakness in China and the collapse in the Chinese stock market. And so from that point of view, we quickly moved back to a predominantly unhedged position. But it is worth flagging that at 70 cents, we still believe that a lot of the downside in the currency has occurred. Yes, it could still get into the 60s or below, but at some point in time, you will see us look to hedge the currency because ultimately a lot of the gains there would have been made. And from that point of view, we want to protect the portfolio against a rising currency going forward. But at this point in time, the fund is essentially 75% unhedged Australian dollars. And this is essentially what we're watching quite closely. What we're looking here is the Australian 10-year bond spread versus the US 10-year bond spread. And what you can see is as opinions of US growth improved and Australia weakened, then the premium for Australian bonds over US bonds has decreased, and the currencies essentially followed this. But going forward, US growth has, as I pointed out, slowed a bit. Australia is obviously still slowing, and so that differential is not moving at the speed that it was previously, and so ultimately the currency will probably stop moving at some point at the speed that it has been up until now. Just in terms of markets and the portfolio update, what I'm showing you here is the index performance in local currency for the 3rd quarter, and as you can see, it's a reasonable tale of woe. Most markets were down between 5 and 10%, but some of the emerging markets were down well over 10 to 15%. From our point of view, what I'm showing on the right-hand side is the performance of the Select International Fund versus the MSCI World Index in Aussie dollars. And obviously both of those are expressed in Aussie dollars. So the good news for us and for the index is obviously that the Australian dollar was weak during this period as well, which provided a lot of protection against these falling markets. From our point of view, we have underperformed for the quarter, and we've underperformed mainly partly because we chose to hedge the currency a little bit early, so we missed out on some of that upside of the falling Aussie dollar, and also partly because we had some investments in China that did very well for us last year, but we definitely got caught out, particularly in the month of July, with some of our Chinese investments, and so they have since left the portfolio, but they have caused some underperformance for the quarter. For the year, the rolling year performance up to the 30th of September, we're still obviously in front of the index, And again here I'm showing you the difference between local currency on the left and the actual performance of the fund and the MSCI, and you can see the effect that the Australian dollar's had on performance, because ultimately there's only 3 markets in the world that are actually up in the last 12 months, and that's the Nasdaq, Europe and Japan, and thankfully that's where we've had the majority of our money. And so from our point of view, we still have some relative outperformance over the year. And going forward, obviously we'll look to, as I said, continue to make good investments and obviously at some point hedge the currency, because we don't think these currency gains will continue obviously every year. Just going through a recap of the markets and some of the big events that occurred around the world. What we've got here is a slide of some of the big events that happened over the last quarter, and I won't take you through each individually, but I'd just flag a couple. In corporate news, obviously the Volkswagen scandal was a big deal. The stock fell 42% in the month of September alone. And I think, to be honest, that's not an overreaction. They've got a lot of problems here going forward. And obviously those problems will roll through into the whole auto sector. Outside of that, from our point of view, we had Disney was weak after they flagged some weakening affiliate fees. It's one of our biggest positions, which was unfortunate, but we're going to keep the faith there. And it's still been a good stock for us in the long run. Obviously, in terms of the market, it was the worst quarterly loss since 2011, so very weak market performance. And obviously, the rout in commodities and the emerging market outflows were part of that. On geopolitics, things probably haven't gotten much better out of the Middle East, and that's worth keeping your eye on. But ultimately, M&A continued through the period. So not a great slide there in terms of news flow. But the good news I could say is most of that's obviously now behind us. In terms of the fund performance details, for the quarter, obviously, these are again all local currency. As I flagged earlier, we did get caught out in July with some of our Chinese holdings, and that's where the majority of our losses have. In terms of the gains, it's basically come from some of our core positions, in terms of our smaller cap positions in Australia, like Ziptel or Rightmove and Ubisoft, which are some of the European mid-cap positions, same with Orpea and Sixt mid-cap positions. We also had some gains on some shorts, which was also heartening and helped obviously improve performance through a difficult period. Again, showing the same slide over the last 12 months, and obviously you can see that we have essentially given back a little bit in China, but you can see obviously significant better performance from some of our better ideas around the world. And again, our core positions are starting to come through here at the top, and you'll see, interestingly, Disney's obviously a great performer over the last 12 months, but was not a good performer for us in the September quarter. Again, all of these are in local currency, and you can essentially see where we've been making the money or losing money over the last 12 months. So just finally on the portfolio update, this is the top 10 as it currently stands. A lot of these have been in there for a long time now. So Disney's been there for a while, Kingspan's been there for a while, Amazon and Facebook have been there for a while, as have Google. So some of our core positions here around the world, generally focused on technology in the US, and then generally focused on mid-caps in Europe, where we see significant upside as the European economy recovers. It's worth flagging that a lot of these companies are still earning well below their previous peaks in an economy that is getting better with plenty of slack to take up. So that point of view, that's the top 10 as it currently stands. But look, the last thing I was going to take you through was just an update on e-commerce, or an update on a core area where we're investing. And so what we do here in the fund, and I think we've spoken, you would have, if you've listened to us before, you'd hear us talk about this often, is we're generally trying to find areas of growth in earnings where the earnings growth is somewhat independent of the cycle. So we're trying to find companies that are basically going to grow no matter what. And from that point of view, that allows us to immunize the portfolio somewhat from cyclical downturns that obviously we've seen quite recently. And one area that we do that is in e-commerce, where we've had a lot of investments recently. And I'm just going to give you a quick update on one of them here, which is Amazon, and why we like it so much. So what we have here is a secular trend that's called e-commerce. I don't think this will be a newsflash to anybody listening that e-commerce isn't growing in importance in the marketplace and obviously taking share from traditional bricks and mortars retailers. From our point of view, we see a lot of winners around this secular trend. There's obviously the e-commerce winners, the guys who sell the products, and that's your Amazons and your eBays and your ASOSs of the world. There's also the online payment providers, so it's very good business for Visa and PayPal. It's very good for postal companies and logistical companies, so in particular FedEx and UPS, but some of the European post companies are very good. And above that, we actually have some more payment providers in Wirecard and WorldPay. And then finally at the bottom, it's also e-commerce is also very good for the proper omnichannel retailers. And what we mean there is the people who can sell you the product in a store, but also online, and essentially omnichannel across the different ways of selling you the product. And so their stores effectively become display centers, and their e-commerce sites become a support for their store. And the best obviously example here is an Apple. If anyone's been to an Apple store, the price of the product is exactly the same in the store as it is online, and you can't find it anywhere else any cheaper. And so from that point of view, the entire customer experience is covered, all the way from customer care to store to pickup to delivery to online support. And so we think people who can dominate that well are obviously big winners of e-commerce. And we'd also flag companies like Nike are very good here, or Restoration Hardware in the US. So what we're going to talk about though is e-commerce in particular. And so I think the big secular trend here is essentially this is global retail e-commerce expenditure. It's been growing at essentially 24% CAGR. Obviously, retail sales have only been growing at sort of 2 to 3 over this period. So e-commerce is taking huge share from traditional brick and mortar retailers. I don't think that should be a surprise to anybody. What we're showing on the bottom slide here, though, is it interesting is essentially that e-commerce is still below 20% of all commerce globally. And what we generally find when we look at these mega trends is when you get to 20%, you actually get this inflection, so you get this acceleration. And we've seen it with smartphone penetration here, and you also see it with notebook penetration and digital musical sales. And so from that point of view, we'd actually expect e-commerce to accelerate in the share that it's taking from the market. And the reason why it's going to do that is because A, more people are used to it, B, the fulfillment channels are getting much better, and the verticals that it's moving into are getting much better. So with Amazon, we have Amazon Prime, which means it gets delivered the very next day, but you also have grocers now delivering it incredibly efficiently, and you have your furniture delivered. So the things that you can actually buy online now is increasing significantly, and the reason why is because the fulfillment and convenience is going across a lot of different verticals. And so I actually think, or we think, that e-commerce is actually going to accelerate over the next 3 years, and it's even though it has been a great place to be, it's about to become a better place to be. And the best example of this is Amazon. Now, obviously, Amazon is the number one player in e-commerce globally. It has a staggering 18% share of all e-commerce sales globally. So, essentially, even if Amazon holds share, then its top-line revenue is going to grow at that 20 to 24% that we're seeing for the whole business. And as I said earlier, we think that's going to accelerate. It's also important to highlight that Amazon has Amazon Prime membership services, which is a loyalty that allows as a Prime member you to get free delivery on all your items and free next day delivery on all your items. And so that's driving loyalty to the platform, and the fulfillment and the convenience is allowing people to not be as focused on price. The other thing to flag on Amazon is they have Amazon Web Services, which is essentially a cloud computing platform, which is an entire second business, which is growing very, very quickly. But from our point of view, we see the company is obviously very big and optically quite expensive, but if you actually look at the cash flow, it's very, very good, and we think their margins can obviously expand significantly in the near term. And the reason why we think that can happen is because of these two charts here. And so what we're showing you here is that Amazon is in the top line here. This is Amazon's share of e-commerce, and as I said, it's roughly 18% at the moment, but that's grown significantly from 12% just 4 years ago. So it is taking a growing share of a growing market. And as you can see here is global e-commerce sales that are growing, and we actually expect them to accelerate. So they're taking a growing share of an acceleratingly growing market. And on the bottom here, you have essentially Walmart, which is essentially had flat sales versus Amazon's e-commerce sales. So Amazon is taking share from Walmart. That's not a surprise. Walmart is, until recently, the world's largest retailer, but about to be passed by Amazon. And the reason why they can do that is because on the right, because of their fulfillment expenditure, the cumulative amount of money they've spent on fulfillment is getting bigger by the day. They've built 160 distribution centers globally. These are very large distribution centers. And so this is a huge lead that Amazon has on their competitors, and this is essentially their competitive moat. Their competitive moat is their ability to get the goods to you on the very next day. And they've built this now, and they've spent a lot of money doing it over the last 5 years, and that's why the company has optically made no money. But what they've been doing is building this dominant position that gives gives them 18% of all e-commerce sales, and a position that's actually going to grow in strength because of the network effects. And the best example here is here in Europe as Amazon Prime members. You start by essentially ordering a few simple things, and then after a while as a Prime member, because it arrives the next day, you even move down into things like toothpaste, deodorant. It's all free delivered, it all arrives the next day, and so Amazon essentially saves your problems, and so it becomes significantly less likely that you go to a retail store and you give more share of wallet to Amazon. The good news for Amazon, that means, is they get more routes in their cars, more drop-offs to more people, and hence their margins will expand after the capex that they've already invested. And we've seen this year where their retail margins have essentially gone from 2% to 5% in the space of 1 year, having been between 1 and 2% in the last 5 years. And this is a huge surprise to people. And the stock's one of the best performers in the markets this year, but it shouldn't be a surprise because they've been telling you this is going to happen for some time. And that network effect can only continue because their competitive moat is so big. And so from our point of view, those margins will go from 5% to 10% over time, and the earnings of this company are quite simply going to quadruple. And that happens reasonably easily, provided these trends continue to be followed. And we struggle to see whether the competitors are going to come from. And so this is the network effect that you get from being the biggest. This is the network effect from spending all the money that they have up to date. And once you're the biggest and you have the share, then that network effect ultimately continues. And we've seen this before with Google. We're seeing it right now with Facebook, and we expect it to happen in e-commerce with Amazon. And that's why it's in the portfolio. So just to conclude on everything we spoke about today, obviously the September quarter was a negative quarter for returns. The fund was down 4.3% versus the MSCI World Index, which was down a bit less than 1%. As we discussed, obviously we didn't get the benefit of the currency falling as far as it did, and we got a little bit caught out in China in July, which we have since fixed. But ultimately, over the last 12 months, fund's still performing very well, and we're still very happy with how it's positioned. In terms of capital, we remain positively exposed to markets, and hence we've got a reasonably high equity exposure. We are just under 80% invested as we see today. Interest rates are going to stay lower for longer. In effect, that is disappointing because it means growth's not as good as what it was, but the equity carry should allow equities to prevail over other asset class and a generally subdued outlook. It's no different to, unfortunately, the outlook we've had for the last 3 or 4 years. In terms of FX, we remain predominantly unhedged, currently 75% unhedged, and we'd look for the Aussie dollar to remain in a downtrend versus most currencies, at least for now. But however, we suspect a good chunk of the depreciation is nearly complete, and so we have obviously tried to hedge currency once already, and I suspect you'll probably see us try to do that again over the next 6 to 12 months. On the stocks, look, we made very confident in the earnings growth of our investments, as I discussed with Amazon. Obviously, while styles can re-rate and derate over any period, we ultimately expect the share prices to track earnings growth, and over the long term, we constantly remain confident with the earnings with the companies we've invested them. In terms of regions, we favour Europe over Japan and Japan over the US, and we are still maintaining a reasonably low weight to emerging markets. Look, in the near term, if there was one risk there for the portfolio, is we would flag that the premium for growth is getting quite high. The companies that can actually grow earnings in the world, like Amazon, is becoming less and less. There are less of those companies out there, and hence the premium for growth in those companies is getting higher. Ultimately, commodities and other cyclical areas have taken a big bath in this period, and we have missed a lot of that downturn in those stocks. But we would expect some mean reversion in the near term, as ultimately markets and Q3 reporting season probably suggest that things probably aren't as bad as what we've priced in. And so from that point of view, you would expect to see us to reinvest, particularly in areas like oil and some of the other industrials at some point through this period, if only to give the portfolio a bit more balance than it has had previously. And that would be the near-term risk to market as you get this essential mean reversion, and that's something we'll be looking out for over the next quarter. Beyond that, we expect it to be a slightly better quarter for markets. It's seasonally a better quarter for markets, and ultimately, as I said, a lot of the bad news is out there. And so from that point of view, we look forward to reporting back in the fourth quarter with some positive returns to talk to you about. That is essentially it for the webinar. As I said, I hope this has been insightful and helped you understand how we see the world and how we have positioned the portfolio. Please don't be afraid to get in touch if you have any questions at all. And thanks very much for listening.